Welcome, traders, to After Hours at Trader's Pulse for Friday, December 12th, 2025. I'm one of your hosts, Tom Hartman, marketing manager here at Trader's Pulse, joined by Peter, Mr. Blue Hartman, to break down the market madness. Yes, I named Peter after the character in Reservoir Dogs, one of my favorite movies, who dies at the beginning of the film. After Hours is your go-to live stream focused on macro trends for retail traders. That's dollar, equity, and policy for the uninitiated. After Hours is brought to you today by Blue Sky, the best-in-class prop firm that offers same-day activation, daily payouts, and no max restrictions. But we'll tell you more about that later. For now, we're going to touch on the big news of the week. Fed week, FOMC, Trump pounds. Peter.
Yeah.
They cut 25 basis points.
Yeah.
Did you?
Right.
What a surprising move. Did you even see this coming?
Look, man, they called Jerome Powell too little too late. But I say he's just what we need at just the right time.
He's the Fed chair we need in a time of darkness. All right. So he cut. I know we had a little detour in November where the beta markets and the futures markets were like, hey, he's not going to cut because he said he might not cut, which was very cute. It's very cute. Jerome Powell, he's not going to cut. We're marking on a rate cutting cycle, but maybe we'll pause. Yeah. How about we get that one more cut out of you? We're going to get that cut, and then let's talk. So this week, Wednesday, we had the FOMC presser. This is where High Priest Jerome Powell comes out to tell us about the economic weather that they're going to create over the next 18 months. And what he said was basically, this is what's been called a hawkish cut. Right? Cut 25 basis points, but saying basically we're going to pause for January, but also we're going to do some injections into the repo market in order to generate, ample liquidity so that we don't have another Powell pivot December 2019 repo apocalypse fiasco. So you're like, okay, I don't understand. Are things going well? Are things going badly? What's going on?
Question.
Let's hear it. Peter?
What is, I mean, I know this. I just want to make sure that the audience knows this. A hawkish, what is that? A hawkish cut. What does hawkish mean, and what does it mean in this context? Just for the
hawkish means that they are telegraphing that they are not going to cut more.
What?
So what is a dovish cut is when they cut and they're promising they're going to cut, like, for sure we're going to cut later on. They might even do 50 basis points now. They just want to make sure, hey, we're going to be supporting the financial markets. And hawkish, a hawkish pause, a hawkish cut, a hawkish right, whatever, they're telegraphing that in the future they're going to tighten financial conditions or at least pause relative to what they're doing now.
Why would they do that?
Well, they made it very clear that their two mandates are intention, right? Unemployment and prices, so inflation. And the problem is that unemployment has ticked up. So that's bad. Number of hours worked down. Salary increases compared to inflation down. These are not good. People will not be able to find jobs. Back in the a couple of years ago, it was like 2.5 something jobs per person. So you can leave your job, find another one. People were even being poached from one place to the other. And now people lose their jobs. Some of them are just, they can't find another one. And we're not just talking about, what the Fed would call just regular plebs on the street. We're talking about real people. Real people's jobs that they're saying is they're finding difficulty.
But wouldn't that make them want to cut more to stimulate the economy? I mean, why would bad news means the Fed steps in?
But the other side, inflation, price inflation. So what they came out and said in the presser is that the two types of inflation that they were worried about, so goods and services, services inflation, which is what they have control over. They're saying we're not seeing any inflation there. In fact, we're seeing disinflation. But the tariffs have caused inflation. But they suspect a one-time increase in inflation. But that one-time increase peaks in January, they say. Now, they also say at the same time that they have no experience with tariffs and they're in a regime they've never seen before. So take what they're saying with a grain of salt. A giant grain of salt, sort of like a salt lick, if you will. All right, because they're basically telling you we don't know, but we got to pay attention to somebody, and we might as well pay attention to the guy who's at the podium. So he's saying, hey, inflation, if we cut too much, we might stimulate inflation and then prices go crazy, and then things are really problematic. If we have another rise in inflation from here, people have sort of settled around this 4.2% area on the 10-year. If it goes up any more than that, we end up in above 5, we end up above 6. Well, above 6, I mean, I don't think we've ever been above 6 in the last like 70 years. That's problematic. Or not 70 years, 40 years. That's problematic. So they want to keep inflation pressures down. So that's the goal. They can't cut too much, but they can't not cut at all. So as Jerome Powell says, don't worry, we think policy is in a good place. If you try to do a Google search for all the times he says it's in a bad place, you'll only come up with one time, which is COVID. So don't expect him to say anything other than that. All right. Peter.
Yeah.
People want to know what I think about the FOMC, even though I'm pretty right quite often.
Yeah,
of people listen to
they
me,
want to know what I think.
They would have been able to take a sweet bet on poly market in order to make 60% of their money back on a surefire bet that the Fed is going to cut. They could be prepared for bounces off the different levels that we call out on Price Action Live, where price goes to, and where we'll bounce from there. But people don't like money when it comes from me. So let's see what the other popular people in the FinTwit space are saying when it comes to markets. So we're going to start off with, and I just want to preface this by saying, I'm very surprised by the candidness and the openness of the conversation around this Fed meeting. I think it's because Jerome Powell is going to be leaving in 3 months. He only has 3 sessions left before he's done. And so there seems to be like this 2 weeks left at your job, last year, senior year of high school, sort of like, hey, let's be ourselves for a little bit. Let's ask the girl out. Let's try to throw that football pass. I don't know what people do in their last years, but that seems to be that feeling. So here we're going to see a clip from CNBC, usually talking heads, but they bring up some great points when it comes to what happened at today's this Wednesday's FOMC meeting.
Let's get to senior economics reporter Steve Liesman, who is in Washington. Steve.
Hey, Melissa. Yeah, the Fed following through on an expected hawkish rate cut, reducing rates by a quarter point to the new range of 3.5 to 3.75, but signaling might be done cutting, at least for now. It appeared to buoy markets, however, with a more aggressive policy than expected for the balance sheet. On rates, the statement, what it did, it used language that it had used in the past to signal a pause, and Fed Chair Jay Powell several times said policy is well positioned.
We now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
Fed future.
So that's a pause. That's telegraphing a pause to rate cuts. So don't expect one in January based on what he's saying right over here. And I think the better markets have like a 90% probability of a pause, no more rate cuts.
Embrace that outlook, pricing in just a 24% probability of a cut in January, 44% for March, and a little bit more in April, a little bit more confidence as the year goes by the way, when a new Fed chair comes in June. The vote count was 9 for cutting, 2 against cutting, 1 for cutting 50 basis points. First time since 2019 we've had 3 dissents. But the dot plotter forecast of future rate cuts was somewhat more hawkish. 6 officials wanted no change in the Fed funds rate at this meeting. 7 want no change for next year from the current rate. The median, however, came out with 1 cut for next year and another 1 for 2027. More dovish was that balance sheet outlook that Melissa mentioned.
Okay, so just quick question here. Would you bet that there's going to be only 1 cut next year?
Only 1 cut?
Yeah. That's what the dot plot is projecting, that the voters are saying, hey.
Well,
right?
Logically, I would say no, but
Right.
clearly Jerome Powell's going to be out in 3. So how are we supposed to know?
Right. So they're talking about this as if, hey, it's only telegraphing 1 cut. Well, this is an opportunity. If you want to be in the futures market,
right,
you can go ahead and place your bets accordingly, being like, hey, no, there are going to be cuts in the future. So that's in futures for rates. That could be in the bond market. That could be for dollars, whatever you want. But not financial advice. Do your own research. But markets is pricing in 1 cut, just so you know.
Interesting.
It will begin on December 12th, the Fed going back in and buying securities sooner than the market expected, focused on bills, but potentially up to 3-year maturities. And here's the one that really was a bit of a shocker, totaling $40 billion for at least several months, also more than expected. Powell insisting this is not quantitative easing, but the Fed maintaining the size of the balance sheet relative to the economy and providing liquidity during times of strong demand. Call it what you will. The market seemed to like it, Melissa.
Call it what you will. I call it QE. I don't know. if you're basically enacting a measure that will push down rates further beyond the rate cut that you just voted on, that's
So just a reminder to everyone, that's what QE is supposed to be. QE is supposed to be, hey, we can't cut anymore. We're at the zero lower bound. So we're going to engineer QE that acts as if it's a rate cut. That's the whole idea. So if they cut 25 basis points, but they need to do $40 billion worth of QE every month, that might as well be 50 basis point cut, is what she's saying.
Right.
that seems to me a form of QE.
Yeah, I mean, I like the way you phrase that. In other words, judge it by its effect, not its intention. I think that's right. But I think what we're going to want to do is watch it over time. Does the size of the balance sheet actually grow in a way that's greater than the growth of the Fed's currency and other reserve liabilities that are out there? I think what's going to happen is you're going to get a flood for a couple months, and then it's supposed to drop off in April. We'll have to watch the management to see if this is quantitative easing in the sense of adding a lot of reserves to the system. Powell's going to tell you, hey, this is just reserve management, maintaining what they call an ample level of reserves.
So this is a difference. This is a difference between, hey, are we using a credit card in order to get through the holiday season? Or did we get a $1 million line of credit? Can we go ham here? Or is this actually just getting us through, and we can't expect a flood of liquidity? So he's saying here that even though we have this $40 billion added, if this is not adding to the liquidity, the propensity of the market to spread that money around, then it's more of a helping smooth things out than inflate the bubble idea here. So he says we have to see over a few months, see what happens.
Yeah, so Steve, it's Seymour, and part of this is understanding what the intention of this is. Maybe you just hit it. Maybe we can put it to bed. There have been some spikes and massive repo infusions over the last month and a half. Is this something to counter, like so much for the end of QT? Do we need this here? I mean, I understand there have been, between the government shutdown and whatnot, reasons why we've seen a spike and concern around liquidity, but talk to me.
Tim, I think you're raising some really important context, that the Fed's change in its balance sheet or its balance sheet stance, and doing so quicker than had been expected by the market, is in response to some of the tightness we've seen essentially in the plumbing of the financial system. These repo rates have traded towards the high end. There's been some disruption out there. And I think the Fed was getting the signal from the market that it had brought reserves down too far and too much relative to what the market required to operate in a way that would allow it to maintain the funds rate where it wanted it to maintain it. So I think the context is important, that the Fed is doing this in response to that tightness in the repo market. And now we'll see if the provision is out there. I will say, for another day, there's a debate that the Fed could have done this differently, in a way of not introducing the balance sheet, not increasing the balance sheet. A guy named Bill Nelson, former Fed guy, Kevin Warsh, other people had other ways to do this. But this is the way that Powell and the Powell Fed are running this system here, the ample reserve.
All right, so that's the idea there, that because we had to shut down and because there was problems within the repo market, that there was stress, your uncle lent you some money, now things are a little bit better, you can get back on your feet. So we'll see what happens there. So that's I find to be a very, for CNBC, very nuanced response to what's going on over there.
Before you go further, I want to say hi to Mikey Davis in the chat. Good to see you. You caught us live. Good to see you, Samantha, as well. And also Ventura Trader here. What's up to you? Tom, what they said there in CNBC, I just want to make sure I understand. So there's the rate cut, 25 basis points. And then there's also something they announced, increasing the balance sheet.
Correct. So this is the Fed is going to be spending up to $40 billion a month buying Treasury bills. So anything less than 3-year term maturity but they're buying this from financial institutions because financial institutions have to buy Treasury. They're forced to buy Treasuries. But because they do that, the cash is gone.
Right.
And so they're not able to lend out as much. That's the idea. So if the Fed purchases those bonds back, then the financial institutions get money. And if the institutions don't want to sit on money, generally speaking, the idea is that they would then go ahead and lend that out into the economy and generate liquidity.
So
that's
why
the
don't
idea
they
here.
just cut 50 if they're going to do that?
Because that seems political, like they're giving Donald Trump what he wants.
Oh my God, I'm so sick of this, man. I'm sick of it.
Well, the next 7 videos is going to be pretty annoying to you then.
Are they really doing this? Like, I'm not going to do it because you told me to do it. Like, it's that type of thing?
100%.
Are there actually people who think that the Fed is independent?
No, it's not that they think the Fed is independent. It's that they know that the illusion of independence is required for all the market participants to behave in the way that
it's 2025, almost 2026. Okay, I hate when people say that as if the year means something, but the whole game of illusion is gone. Okay,
it isn't.
Social media, internet, all that stuff. Like the only illusion I have is when I watch us and I see us all dressed nice and well on camera, knowing that we're about 30 pounds overweight. That's the only illusion that exists, all right? What we hide with our clothes.
You know, when you're with your lady and you're out in public and you're saying whatever, and you look over and she's like, and you're like, ooh, I better maybe let me pull back what I'm saying at this party. Maybe let me change how I'm doing. This is how it works. The thing is, the Fed is not the one making any of these decisions, ultimately. Okay. It's the market that does it. Right. The market prices in certain things, and then the Fed either has to honor that priced in behavior or not. If they don't, now they're doing something. Now they're going against the grain. Now things get really volatile. That could be crazy. So they don't like doing that because the whole thing is they want stability. And so the market is priced in. So the market does things. They price things in and they go, okay, Fed, support us and say that what we're doing is the right thing so that we can continue doing what we're doing. And if the idea is that if the Fed being independent, if they're doing that, great. Then the markets know they can do whatever in order to make sure that monetary policy stays supportive to what they're doing. If they go, hey, we're going to need more liquidity, give us some liquidity, Jerome Powell. Give him a month, 2 months, 3 months, he'll get you the liquidity. He's not let you go dry there. He's not looking for a sober market. But if it comes to Donald Trump or the Trump administration, they don't know what he'll do. If the market goes, okay, we need to price in a drought, we need to price in a recession, and Donald Trump goes, no.
All right.
Well, look, that's problematic. It adds volatility and uncertainty.
What I want for the next season of Trump is for
You mean his next 4-year term after this one?
I want him to make himself the head of the Fed. That's what I want. I want him to put him in that position. I think he would do it. I think he's the type of person who would do it. Has anybody suggested this to him?
He suggested this.
All right. Let me not drag it on. But so what are we going to watch now? What are we seeing here?
We're going to see here. This is Jim Bianco, which I like on Bloomberg. Wait, is this Bloomberg? I think it's Bloomberg. And he touches on a couple of things. We're not going to watch this whole video. He touches on a couple of things that I think is important. He really cares about the politics of the whole thing. All right. So let's see what he has to say. I'm going to jump around this a little bit.
Of Bianco Research. Jim, what's your first reaction to this decision, which, as Bob was saying, isn't as bad as it could have been? It could have been 4 dissents or 5 dissents, only 3 dissents. Is this a victory for Jerome Powell?
It's a victory for Jerome, but I'll take the other side, Bob. I'll say that it's not as good as it could have been. I was hoping for a 7-5 vote. I was hoping for a Fed that was more divided, that was more independent, that was going to send in a message to the administration. You could put a guy in that wants to go to 1%, but he's not going to bully us to cut rates next year just because he's the Fed chairman. They kind of left the door open. I think that the Fed can be bullied by the next Fed chairman to do the bidding of President Trump.
Bob,
right. So that's the idea, that politics idea there, Peter. They could have still cut 25 basis points and done the not QE, but they could have had more dissenters on the board before making the choice, more hemming and hawing, to make it seem more like, hey, we're not doing this because we want you to do it. We're doing this. We're doing this because we think it's the right thing, but we have a problem with it. But the fact that they're not doing that it was way less dissent. Bianco saying that sends a message to the markets as saying, hey, you don't have to wait till May for the new Fed chair to come in. We're already bending over.
You were saying that you wanted to respond.
Not as good as it could have been with more dissents. I think if you're the administration and you're invested in this market, this is pretty much as good as it could have been, other than no dissents. I'm not sure how additional dissents make this better.
Will McKee dissent at the press conference?
Well, let's find out. Mike, you were parsing through this. You've got something to add. What do you see?
Yeah, well, the point I'd like to make is that the SEP shows that growth is going to pick up significantly next year.
Jim, this is something that is near and dear to your heart, as you call yourself a self-dubbed inflationista. Do you think that this really adds to that inflationary pressure if the Fed essentially is accepting that they're not going to get down to their inflation target for 6, 7, potentially even 8 years?
I agree.
That the Fed might not get to the 2% target rate in like 8 years. Wow. All right? That's the length of time for the dot-com crash. That's the length of time for the global financial crisis. He's saying for the next period of time, for the next 2 high schools, you're not getting below 2% inflation rate. This is what the Fed is thinking.
Well, didn't we kind of already know that?
No, a bunch of people think we're going to 0%.
Oh. Does Trump want that?
Yes.
Right.
All right.
Agree. I think that the Fed has to be very worried about that. We're worried about affordability right now. This price CPI is up 27% since the end of COVID, and that's what people are upset about. How do we fix that? We need the inflation rate to run below 2% for a while so that wages can catch up. If the inflation rate is going to stay at 3 and moderate to 2.5, that is going to keep the affordability anger white hot over the next year to year and a half or so. And so I don't think that accommodating that by cutting interest rates is going to help. And that's the question I hope the chairman gets is, how are you helping affordability with 175 basis points of cuts in the last 14 months?
All right, because here's the idea, right? Great point, Jim. I know, Jim. It's great. He's saying prices don't come down. We all know that. Prices don't come down. The only thing that helps to mitigate any of this is if wages go up. For the same job, you need to make more money. That's the only way to cut into the inflation. And if the cost on average for things is up 27% over the last 5 years, we need soon for prices for inflation to slow to the point where job increases, your labor can actually increase, and you get paid more for you to be like, okay, I can actually buy groceries again. It feels a little bit different. Sure, I'm never going to go back to a milkshake being a nickel anymore, but I can live, I could buy a house, I could feed my family and all that sort of thing. If we don't get that, we have the populist problem, the white hot anger. And the Fed goes, okay, I hear your concern. Let's go ahead and put some more gas on that fire anyway. So he's like, what's going on here? This is a problem. All right. Before we move on to the next segment, I do want to, Peter, you want to kick it off to someone there?
Yeah, there's some couple of questions in the chat. First of all, our friend here, I'm sorry, I can't pronounce that. Should I try? I don't know. Hello, have you guys added the linear regression reversal strategy on Traders Post yet? I see the indicator, but not the strategy.
Oh, that's interesting. No, I haven't added the strategy yet. I'm still working on it. You're going to get it next week.
Awesome. And we have Mikey Davis who asks now, what the hell is an inflationista?
It's this class of people, just like the bond vigilantes or whatever. There's these terms for people who have certain views on the economy. And the inflationista started back before inflation picked up. They were like, inflation's coming. The Fed, they're sending money directly to people. The Fed is pumping in trillions of dollars more money than the market has ever had in any one time. Markets were soaring, and we didn't see inflation anywhere. People were buying meme coins like crazy, buying a third or fourth home. It was crazy. Good times roll, and they were saying, the inflationistas were saying, we're going to pay for this. Inflation's going to go up to 9%, which is exactly what it did. So I remember when he was calling for it, people were like, "You crazy, man. You crazy. Inflation 9%? We're at 0% interest rates. We haven't had inflation since the 1970s, old man. Get out of here." Turns out, dead right.
Mikey Davis is asking, did you check out TradingView lightweight charts, Tom?
Sure. I mean, I've integrated lightweight charts in different projects. So I might actually go through how to integrate that in the future for people's personal things so they can back test using their own systems. It's just that I'm sort of waiting for massive.com to release the futures data for individuals, so that, because futures is what so many of us trade. So maybe I might do that for stocks, but that's basically what I'm waiting for.
Awesome. We're up to date.
All right. Well, a quick word from our sponsors, and we'll be right back.
Looking for a prop firm that actually plays nice with automation? Meet Blue Sky, built for serious traders. And with Traders Post, it just clicks. You connect Blue Sky inside Traders Post, route your TradingView signals to paper or funded accounts, and let it auto-manage entries, stops, and targets. You control risk per trade, filter by session and symbol, and pause or resume with a single switch. Every fill is easy to review in one dashboard. Funded accounts can request payouts daily with launch plans starting at $49. Get funded with Blue Sky. Execute with Traders Post. Apply today at bluesky.pro, BLUSKY.pro, and plug in your edge. Trading involves risk. Use proper risk management.
All right, so let's take another look. This is going to be I think this will be our last one. I don't want to push it too hard. There's so many videos that I wanted to go through, but I really want to get this one in. This one's from Darius Dale, who talks about, actually, no, after this, we're going to do one more with Kim Carson. Got to get that Kim Carson video in. But let's take a look at Darius Dale, which I think is the best I've ever seen him on the mic. Let's hear what he says here on Bloomberg's The Close.
The Fed deciding to cut rates in its final decision of 2025. As we look ahead to 2026, the FOMC is maintaining its projection of only one cut in 2026, also in 2027. Here to discuss this and more is Darius Dale. He is the 42 Macro, a macro research firm. Great to see you, Darius. So you think about what we got yesterday, the expectation of a cut, perhaps a hawkish cut, but press conference, I'm not quite sure if that's what was.
Well, thanks for having me. Appreciate you guys for being on. In our opinion, that might have been one of the most historic FOMC events in our lifetimes. Mm-hmm. This is a Federal Reserve that, in the midst of a nationwide affordability crisis, effectively said, we have to expand our balance sheet. Mm-hmm. And we have to give the repo market the liquidity that it needs for hedge fund leverage and retail margin debt to continue expanding. And so in my opinion, that represents a significant sea change in monetary policy in terms of the Fed's reaction function, a reaction function that we already thought was going to change anyway next year as a function of the next Fed year.
Well, so this is what we were saying before, that the Fed had basically said, hey, we're cutting. We know there's an affordability crisis, which is the new term for inflation, but we're going to cut. And yeah, too bad, so sad. We need the financial markets to keep working.
A little bit more about that, because it's difficult messaging, right? They're buying Treasury bills, but it's really being cast as reserve management. But you still have the folks on social media and the like saying that, no, this is QE, including yourself.
Including myself. I should have brought my bubble, my bubble bowler. No, look, I mean, I'm being tongue in cheek about it, but what it does represent is it represents an erosion of central bank independence. Now they're going to couch it as reserve management operations or whatever they want to couch it as. But the reality is the federal government's balance sheet and the growth of the federal government's balance sheet has gotten too large. And so ultimately we need the Fed to take pressure off the system in order to, help sustain the bull markets and assets, sustain growth in the real economy. And ultimately this, again, like I said, this is a very significant change in U.S. monetary policy.
It gets to this idea, though, as whether the market can ever stand on its own again. It's funny, before this show, I was having a conversation off camera with someone about the global financial crisis, the start of QE, QE2, QE affinity, and everything else in between. And it gets to this idea that the Fed does try to pull back from time to time, but it's never really found a way to permanently pull back. And I'm wondering if we ever get back to that.
That's a disingenuous question. We all know they're never pulling back. All right. No one wants them to pull back. No one's asking them to pull back. Unless you're Peter Schiff, no one's expecting the balance sheet to stop increasing for debt to not be monetized. let's just say what we all know here, okay?
It seems unlikely from this starting point. I think that we're probably multiple market and economic cycles away from having that, sort of come to Jesus moment with monetary policy. But between now and then, if you look about from a risk-taking perspective, from our perspective and the perspective of many of the top institutional investors on global Wall Street, there's really only 6 things that impact asset markets: growth, inflation, monetary policy, fiscal policy, liquidity, and positioning. Growth's already improving. Inflation is going down. It's a tailwind currently. We just saw the change in monetary policy. That's good. Fiscal policy's been tightening, but it's going to be easing significantly next year. The liquidity cycle is already still in an uptrend, and the Fed is adding more liquidity to the system. So the only one of the 5 cycles that's an issue right now is the positioning cycle. And we see historic degree of crowded bullish positioning, but we know the positioning cycle is not a catalyst. So when you have all that good news in all the other key macro cycles that matters, it suggests that the risk is that the markets can start to bubble.
It's interesting you say that too, because we have seen a little bit of a rotation in U.S. public equity markets away from that high concentration in tech and AI, but that is still the dominant theme. And I am curious because this came up in the press conference yesterday with Powell. It was brought up today in an interview on Bloomberg with Robert Kaplan, a former Fed governor. And it gets to this idea as to whether that AI trade and the AI build out is now a macro economic story, and a story that would have to be dealt with to a certain degree by the Fed.
Yeah, well, the Fed's going to get dragged kicking and screaming to deal with it anyway. But our take on AI is this. We're going to, at the end of this rainbow, whatever it is, it's going to be a secular bear market in either the stock equity market or a secular bear market in society. And so right now, I think the starting point you need to recognize is that we are very much in the early innings of what could potentially be a bubble. You don't want to be short that. You don't want to be fighting that. I know that investors look at valuations, but they're not factoring in all of these positive liquidity and monetary dynamics, the fiscal policy dynamics, as well as the free cash flow the index currently generates relative to what it did back in the 90s.
Interesting. So you're saying in your view, that bubble, which a lot of people would have an instinct to maybe lean away from or short, but in your view, it sounds like it's just going to expand from here.
When bubbles are inflating, you want to be long them. When bubbles are inflating, go buy them. It's pretty straightforward.
The problem is you're trying to time it so you don't get caught up in it.
Can I say something on that?
Yeah.
I don't believe in market timing whatsoever. We're trend followers at 42 Macro, quantitative investors.
Yeah.
I don't believe that you can sell the exact top of the market. I don't believe you can buy the exact bottom of the market. But what you can do is sell near the top and buy near the bottom with trend following processes like ours.
All right. Well said. Darius, always great to have you.
Boom, Darius. Boom. My God, mic drop. That is the best I've ever seen him. Got to get that guy in person, man. Woof. All right. So, Peter, just to recap for people. The reason I like this interview so much is that constantly on Price Action Live and different places on Traders Post, people are on my case being, why do you care so much about macro? Why do you force Traders Post to do a macro show every Friday and send out macro information by email every week? Why?
Wait. You need the context in order to send your trades, no?
Exactly. And so traders will say this all the time. No shade to the top traders out there, the prop firm traders and all that. I totally understand that. But not just trading price action without understanding the context at all is, to me, it's like driving without any indicators on your car, without any map of what's coming, of where you are, anything like that. You're just like, I'm going to go left, I'm going to go right, I'm going to go left, I'm going to go right. Oh, great. I didn't die today. Yes, this is not, that's not long-term thinking. You need to know what season you're in. You need to know what seeds to plant. You need to know what to do. And I just wanted to actually mention here, Peter, just a couple of, these are the points I have to keep in mind for why it's important for prop firm traders, intraday traders, and swing traders to know about macro trends. This is my list. All right. First, you got to pay for your prop firm accounts. You got to pay for your intraday trading. Now you can go do your job and use that money in order to go pay for it. But wouldn't it be better to have strategies out there, other types of investments, other types of strategies that are generating income that you can then use in order to do your prop firm trading, as opposed to just taking it from your savings? So understanding these general macro trends provides you opportunities to put on trades, whether through options or futures or whatever it is, to take trades that are secular trades, liquidity trades, what have you, that's long-term and takes advantage of these trends. And when these things happen, you can end up making hundreds of percent in profit. So you're planting the seed and you know 2 years from now it might pay off, or 6 months from now it might pay off. So those trades can end up paying for your trading. Now, I get it. There's the profitable traders out there who go, Tom, I'm pulling in $50,000 a month off of prop firms. I don't need any of this. Okay, totally understand. 95% of people fail. Okay? For those people, you need to pay for your prop firm accounts, okay? You need to pay for what you're doing. And these other strategies are less volatile, right? Because you're betting that summer's going to come while you're in winter. This is a great bet to take, and vice versa. Next, in the shorter term, even for intraday and swing traders, volatility affects many traders' trading styles, right? You're dealing with ATR, you're dealing with different volatility measures, and this will affect a lot of your entries and exits. And so having a sense that, hey, coming up ahead are road bumps of volatility that I might want to pay attention to, that there's some chop coming up ahead, that the road is not paved ahead, hey, that's extremely useful. Now, we already know this when it's going to be CPI day or GDP day or Fed pressure day. Hey, let's not trade around those areas because those are the big road bumps. You don't want to get completely rinsed on. But there's these effects that are happening constantly all the time. And knowing what season you're in, knowing what's the environment, what the landscape looks like in front of you, helps you decide how to trade, what kind of trading strategy to put on, which is the other thing. People who don't look at the macro landscape, either for anything from 1 quarter out to 2 years out, they trade assets that they shouldn't be trading, right? How many people wish they were long gold, that they just bought a long gold position every day at open and just held it to the end of the day, again and again and again and again, as opposed to trying to thread a needle on NASDAQ? How many people wish they'd done that? How many people wish right now they were buying silver when silver was up to $65 an ounce? They just ride that train up, right? These are all effects that are being buoyed because of macro trends. And if you knew that, you would know what assets to trade. Fourth, you miss out on trends. So we've seen this on Price Action Live with ourselves. Mike talks about this all the time. He'll put on a scalp trade or he'll put on a trend trade. And sometimes a trend will start that day or will happen that day and you missed it because you're just too busy scalping. And it turns out, hey, if I just held one contract at the open over here at the peak and open, I could have just made 3 to 4 times more money than I did scalping all that day. And people will rinse their hands going, well, at least I made some money. Like, no. You could have caught that trend if you understood why that trend was happening and why it's happening at this period of time, because of positioning. Darius was just saying on the video that we just watched, the 6 key characteristics. You want growth, inflation, fiscal and monetary policy. You have liquidity and positioning. So if you're paying attention to those 6 things, at least, and you're looking at that as you start your day, you're going to be better positioned as to what's happening in intraday and when you're swing trading. And finally, and that leads into the last one, adjustable confidence. Peter, so many people make mistakes, whiff out on the trade, go on tilt, because their confidence level as to what they're seeing on the chart is low. So because they're looking at price action and go, oh, that candle closed above that one, and they're not understanding the greater macro picture of what can affect that asset for that day, they end up flipping, and they go on tilt. They go, oh, I didn't realize what the position was because I wasn't looking at the option space to see what the volatility surface was like. Oh, I didn't realize that this information was coming out and OPEC was going to move oil. Oh, I didn't realize that geopolitical occurrence was going to affect gold because China is buying gold at record amounts. I didn't realize that go higher. I thought it was overbought and I thought it was going to go down, so I shorted it. Because people don't know what the landscape is in general or in the asset that they're trading, they end up leaving tons of money on the table and worse, giving a lot back to markets. So understanding what's happening in the macro space, keeping up to date to it day by day by day by day, even week by week, makes you such a better trader, even when you're trading prop firms.
How does that relate to ignoring the narrative, paying attention to price action?
Well, when you're ignoring the narrative, you're looking at the price action, but if you only pay attention to that price action as to why that happened in reverse. You go, hey, what happened over here? Why did this happen this day? And then you find out the information later on. You end up with this hindsight bias where you go, well, I could see that that's what happened in the chart. But the next time that narrative is about to happen, you won't know how it feels before you get into it. A lot of these intraday traders, they're not sitting there with, let's say, necessarily automated strategies or very specific rules that they're following. They're vibe trading. Well, you can make your vibe trading much better by being plugged in as to what are the actual things that are moving markets that you're trading in. And for that, you need macro trends.
So you don't think you can get narrative contamination if you pay attention to the macro space too much, get manipulated by the propaganda?
I mean, you can, but that's what the practice is. It's sort of like you can have that same feeling with the chart. There's some people that if you gave them a chart and you just show them the last 5 candles, they can tell you what trade to take. But you show them the last 50,000 candles, they make mistakes all the time, or vice versa. The more data you have, yes, it can be confusing, but as you internalize it, you get a sense of what this means, what the setup looks like, what it feels. You're not only looking at price action, look at price action in the context of what happens. So maybe this trade setup that you're dealing with happens on when it's winter in markets, but not in summer. Or put it in a way that people can easily understand. There's a time to buy the dips and there's time to sell the rips. And you can have the same type of strategy, but you're reversing the way you're dealing with it depending what regime you're in. All right. Well, that's my spiel. I wanted to touch on Carson here, but Peter, you already did play this video on Tuesday on office hours, where Kem was basically talking about the idea that having multiple different strategies, is a way of increasing your profitability over time, decreasing your volatility per unit of decreasing your risk, and being able to take advantage of idiosyncratic risk and regime changes as time goes on. So you want to go take a look at that video, because it really lends itself to. Go ahead.
Sorry, it really lends itself. Sorry for interrupting.
That it behooves you to go out there and create, and set up 5, 10, 15 different types of trading strategies and run multiple ones of them. Some are long-term investing, some are by the dips. Other ones you're looking for event-driven risk. Other ones you're manually trading. There's different ways you can do about it. And when you treat your whole trading experience as multiple strategies working together, well, then you can sail through different types of seas with hella confidence.
Well, the important bit from what I remember from that video for strategy diversification is that you want to be diversified, but not in the same domain. Like, you don't want all your strategies to be on the NASDAQ or the S&P, or else as that fluctuates and your risk gets gets exemplified, then all your bets are screwed there. So you want to be in different markets. Is that right?
That's right. And Kem also makes the point here that some people think that diversification is just within assets. Just diversify your asset classes. But and I never really thought about it until he mentioned it. Just by being in assets, that's a correlation. So you can be in things that are not assets. There are other types of things you can trade, other types of markets to be in, so that you're not correlated to the same thing.
Can you maybe show the title of the video just so people can go and check it out in case they don't want to go hunting for it?
Yeah, absolutely.
It's a really good listen. Carson. I don't think we're saying his name properly. I think it's Carson, right? Carson, something like that.
People say his name in all kinds of different ways. His name on Twitter is Croissant. So yeah, the video is called "The Market is Topping Out" from Ken Carson on the Adam Taggart Thoughtful Money Show. Very, very interesting video. Awesome. All right. We'll leave that there for this week. Thank you everyone for watching. Give us a like and a subscribe if you're interested. It's always nice to collate all this information for you, aggregate all this information so you don't have to go out and hunt it. It is hours and hours and hours of content that I go through in order to make sure you get just the cream of the crop. And all I ask is for your participation, your emojis, your likes, your praise, your applause. And if you want to name your firstborn or secondborn child after me, I'll take that too. But thank you everyone for being here in the chat. We'll be back next Friday with even more after hours at 4 p.m. Eastern Standard Time. If you want to watch us trade, that'll be Tuesdays to Fridays from 9:30 a.m. Eastern Standard Time to around 10 o'clock, 10:30, where you can see Traders Post live in action being used by we're retail traders, but we've been around for a clip, Mike and I. So it's pretty interesting to see that. We get all kinds of guests on the show. And then we'll also have a blueprint next Thursday, as well as office hours on Tuesday.
Mikey Davis asks, isn't being in any index already diversified?
No. So the indexes are used as hedging tools from different players, different hedge funds, different market makers, or what have you. And so initially when the indexes were first created and you bought an ETF for that or what have you, it did have diversification. But as more derivatives get created, and because those assets are used to hedge, they then all move in a similar fashion. And this is aside from even the passive index flows that place a forced buyer inside of the markets. So no, they're correlated to liquidity and they're correlated to positioning.
Awesome.
All right, guys, it's been fun. Christmas is coming around the corner. We have one last week of content before we're paused for about a week. We'll be back in the close to the new year. But until then, we wish you, as always, happy trading.
Thank you.